Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. Trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson from WallStreetWindow.com. Mike, welcome back to the show.
Oh, it's great to talk with you. We're at an amazing time, at least when it comes to the financial markets, of all the wild gyrations we're seeing. Monday, the market was down so much in the United States, the S&P down on the open over 7%, that they actually halted trading on the entire stock exchange for 15 minutes, something that they hadn't done not even during the 2008 drop. They last did it in 1997. And really, I think everyone in the market is in a tough situation right now. And I mean everybody. I'm not trying to sugarcoat things. I think everyone listening, and I include myself when I say this, probably is not up is not sitting with a record high account balance, but is probably lost something over the past couple of weeks.
Now, of course, some people were calling it a panic, a collapse. How would you describe it?
Well, it's quite interesting because when it comes to the U.S. stock market, I've been through two bear markets, and also bear markets in other markets such as gold and mining stocks. But when it comes to the U.S. stock market, I think the drop so far is sort of unprecedented. I was thinking last week that the market might rally, we might get a double bottom, and then there would be a good time to sell or short or do something in a couple months, because that's what happened in 2007. The market dumped that August about 15%, then came back. In the year 2000, there's a similar drop that April, and then a rally into Labor Day. But this thing is falling straight off the high to 20% last week. And even in 1980, the famous 87 and 1929 stock market crashes, the market had a bigger bounce before it got to the point where it was Monday, which it was down 20% from the high Monday. But in 1987, the Dow bounced off its 200-day moving average and had a nice rally close to the high. And even in 1929, there was a better bounce preceding that crash. I'm not trying to suggest that we're on the verge of crashes of those sorts, but just to say that that's, how the stock market has been trading so weak. And at this point, the market, even though as we're speaking today, it's up and hopefully it'll go up tomorrow or maybe even a week or something would be nice. However, it's sort of a black hole because the market has broken its 200-day moving average and is far below it. And that is my definition of a bear market, when a market is below the 200-day moving average, and that then becomes price resistance. And it's going to be some time before the market is able not only to just rally to that, but stay above it. So I believe what we've seen over the past few weeks is really the start of a bear cycle. I wish I was able to predict it before it began, or that it would have bounced back up. But, because every other bear market, it bounced back up before it's gotten this low. but no. So that's kind of a tough situation, and for everybody. And I think the problem I see is someone living in the United States and communicates with people, through email and even, friends calling on the phone. There's a lot of denial of what is going on. So, for example, a lot of people are saying or believing that the only reason the market is dropping is because the television media or want it to fall to hurt Donald Trump. And therefore it's like fake news. They are saying that the virus situation is exaggerated and it's just the common cold, and they're using this to try to make Trump lose. And honestly, I do believe and hope that the virus situation may be exaggerated. And the way the media is, it grabs onto a story, and tends to really repeat it over and over again. And this, every time there's a new case, they report it, or someone dies, they report it. So it is creating a lot of fear, perhaps exaggerated fear among a lot of people. However, in Italy, they've locked down their entire country, and they're not doing that to hurt Donald Trump. They don't believe, the politicians in Italy are throwing their whole country into a recession. They likely will get thrown out of office. They're not doing those things because they like or don't like Donald Trump. And the important thing, the reason I say this stuff is that people have losses on their accounts. Just about everyone in the stock market now does. And instead of accepting that, I think what people are doing is denying the situation by trying to dismissively say, oh, this is not real. This is fake. And in the last two bear markets, when they began, there also was a tendency to think, that I saw people express and even told me in person that, oh, these declines aren't real. This is what people were saying when they started. This is the news media. If people just wouldn't be scared, then they wouldn't sell stocks, or they could just be positive thinking all the time, then they wouldn't sell stocks. So at those cycles when they began, I took that as denial. And the reality is the news doesn't really matter that much in when it comes to what the market's doing. In 1918, 1919, that was the Spanish flu. And, millions of people around the world died. 600,000 people in the United States died during those 2 years, but the Dow went up 80%, because the Dow just happened to start a bull market almost the very month that virus back then broke out. So the trend in the stock market was up, and it climbed the wall of bad news. And now, whether the virus was a trigger or not doesn't matter. We're in a downtrend. The market is below the 200-day moving average, substantially below it, and those account balance losses are real. And they can't, that's real. Whether someone listening thinks the virus is real or isn't real, those losses are real. And as myself in January, I bought energy stocks, in a couple other things that, I was thinking could be great for the year. And then in February, they fell enough where I got stopped out of them. I had a stop loss point. And when I got out of those positions, I had to admit to myself that it was a mistake. And if I continue to hold them, I would lose money. Maybe mistake is too strong of a word, but it was a situation that if I continue to hold, I would just keep losing money. So I had to accept that was really happening and take action, or I would have been getting killed on Monday when those stocks fell 15% and the price of oil fell 30%. So I think everyone listening has to accept what is happening in these markets. And if they're suffering substantial losses for it, that's a sign that they need to make changes of some sort. That might be reducing their positions. If someone's on full margin, they're getting killed. They got to get off of that. If they're fully invested in just the stock market, they may have to raise cash. And they can't just say this isn't really happening. It is happening. And gold is up year to date. Gold is still above its 200-day moving average. The Federal Reserve is already did emergency rate cut between the last time we spoke. They're going to lower rates again. And then, before the end of the year, maybe within weeks, they're going to do a new bond buying operation. All these are going to be positive elements for gold. So it's just gold is something people really need to have in their portfolios of some way or another. You know, the trend in gold has been up. It's been beating the stock market since October 2018, so the mining stocks. So they've been something to make money in. But now, with interest rates at zero, you know, you buy a 10-year bond, you can't even make a percentage point. Gold is just now is going to get to the point where it's going to be a necessity. But in order to make changes and buy that or reduce the risks in an account, you have to accept that you need to make changes and that what is happening with the stock market is significant, and it's a sign that things are changing one way or the other, just like they did during the summer of 2000 and 2007.
We'll have more with Mike Swanson right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Mike Swanson. I remember, Mike, it wasn't too long ago, it could be only a few weeks, where people kept saying, oh, we couldn't have a major drop in the markets or a recession because the Fed has our backs. Well, they've already done one major cut. They don't have a lot of interest rate room to cut much further.
Well, that's the big problem. And I think, first of all, there's two problems. One is exactly what you're saying, right? So as a trader or investor or just watching the markets, and you think, well, the Fed's going to lower rates and that'll help the market go up. And they only, you know, they can only now do it probably two more times. And then you're forced to ask yourself what happens when they run out of rate cuts. So now it's hard to get excited when they do lower rates, just because of that fact, and because they're so low, they won't have much stimulative impact on the economy. But there's a second, more dangerous problem with this, and this again is why people need to own gold when I try to explain this, is that rates are near zero. The 10-year bond is below zero. And this is the culmination of a bond bull market that's been going on since 1980. This is the peak of that bull market. But it's not simply treasury bonds that have gone up over these years. It is corporate bonds that have been into a tremendous bull market. And the yield on those bonds just the other week for the triple B junk bonds, actually on Friday when I last looked, they were yielding 2.6% for, a 10-year junk bond of not shady, but companies that would be at risk if there's a recession of you getting paid. So that's junk bond debt, 2.6%. Well, the rates have fallen so low because of what's going on with the treasury bonds that it no longer makes sense to want to buy these bonds. I don't want to buy a complete junk bond and make such a low yield for the risk I'm taking. So the bond market is such a bubble now that almost no one is going to be buying it, for an investment. The only reason to buy it is to think, the only sensible way to buy it now is to say, well, I don't like the stock market, so I'm going to buy a 6-month bond or 3-month bond just to get something instead of pure cash. But you don't want to buy these longer term bonds because you don't want to lock your money up for that long, and then there's an inflation threat where you'll lose money. The end result of this is that bonds, and this is probably more significant than the action in the stock market, although, you don't notice it, or we don't notice it on a daily basis. But the bond market, especially the corporate bond market, is on the verge of it's probably topped. And that means it's going into a bear market. Well, if the corporate bond market goes into a bear market, all the stock buybacks will end, and it'll be harder for companies to raise money, and a lot of companies are going to go bankrupt, and these bonds aren't liquid. These ETFs that hold them, such as J&K, LQD, can hardly sell the bonds that are in them if there was, a lot of selling volume in those ETFs. So this is all a dangerous recipe. And the solution, this is a reason gold will go up, because if the bond market is no longer a viable investment because treasury bonds are so low and the yield and the risk on the corporate bonds no longer make any rational sense, the only alternative is to have some gold to compensate, if the bonds continue down and the dollar goes down with it and so forth. And so this isn't happening in a noticeable way today or even the past 2 weeks, but bonds have fallen. The corporate bond market's fallen, while the treasuries have gone up. And I think this is going to be, over the next few years, the real problem. If falling real estate prices and the mortgages were the problem of 2008, I think this is going to be the problem over the next couple of years. And it's going to, it's not going to be bullish for the stock market, to say the least.
We'll have more with Mike Swanson right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration, with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, what do you think is going to happen to crude oil with a lack of demand around the world in this price war between Saudi Arabia, OPEC, and Russia?
Well, like I said in the first segment, it took me by surprise. I thought oil had the potential to do well this year. It the oil stocks rallied to their 200-day moving averages in January, and if they were able to go through that, that would have triggered my definition of a bull market. But instead, that it could continue to act as resistance, and now we see what's happened. I think it's going to take some time before oil goes into a bull market now. If it could have had the possibility of doing it this year, well, now it's probably 2 or 3 years or a year or two out from now. And it's probably going to remain depressed and weak as this current decline in the stock market plays out. However, at some point, I do think oil and energy stocks are going to be great investments and buys, particularly when the U.S. dollar gets more bearish and other problems associated with that spill out. It's going to cause inflation. So it's hit now, obviously. It can go lower. I mean, we could go to 25 or on oil. It got there a few years ago. So I think ultimately it's going to be a great buying opportunity. Perhaps if I forget about gold, the precious metal, and just talk about stocks, I think mining stocks are probably the best investment now to put money to work. And at some point, it'll be the energy stocks. But I was early on that in January, but the time will come, whether the end of this year or next year. So it's something we can't just forget about, even though it dumped this week.
And of course, as they say, necessities need to be met. There are certain things that are luxuries and some things that have to be produced, whether you're in a recession or not.
That's certainly right. And one example of that, which is also worth taking notice, is that the agriculture commodities, they are actually holding up fairly well considering the decline in everything else that's happened this year. For example, the DBA ETF, it got to 1660 in January. Its 200-day moving average is at 1583, and it's currently trading around $15. So I think that also has the potential to do really well. And what's crazy in a way is gold and agriculture commodities are trading less volatile than the U.S. stock market is. I mean, gold is not gapping up 7% or down 7% every single day, and neither are agriculture commodities. And agriculture, as you said, is a necessity. We're not going to stop eating no matter what happens with the economy or the stock market, or whether you live in Italy, you're told to stay in your house, you're still going to eat.
And even in Wuhan, people were allowed to go out and get necessities.
Yeah, you got to. You got to be able to go to the grocery store or the drugstore and so forth, for sure.
So, Mike, what's your overall view right now? What should people do and what should people not do?
Well, I just think it's time to really, the biggest question is take a look at your investments and, your portfolios and figure out the risk, the volatility or drawdown you've experienced, in the past couple of weeks. Is it something you'd want to repeat again? and then, if not, then make some changes, and cash and gold is the simplest thing, to do. Put some of that in your account and sell stuff that isn't doing that well. Going into this recent peak, we saw a lot of stocks go crazy. For example, Tesla was like $300. It was $250 in October, and it went to $950. It went straight up. It went like crazy. And there's a few other stocks that did similar things. And a lot of people got into that or tried to, as they were topping out. And those are acted like the internet stocks of 2000. A couple of them did the same thing. And Tesla is I'm just trying to use it as one example, but, stocks like that, or the Apples or the Facebooks, that are trading below their 200-day moving average now, those might be ones to get out of and get into gold ETFs or some mining stocks also. And interesting enough, the junior mining stocks, for the most part, have not dropped on in the past couple of weeks. They're just kind of sitting there, which tells me that, there's not enough people in them to make them collapse like what happened in 2008. But the stock market volatility is kind of trapped so many people that they don't know what to do. And I don't think most people are yet making any changes. And once people start to do that, I think that's when the gold stocks will really come alive and match what's been happening with the metal. You need the type of person that's got their Tesla and they're stuck in it, or their Facebook, to get out and then start to think about what to do next or what's better. On Robinhood, the popular brokerage in the United States with 10 million accounts, less than 10,000 people out of that 10 million own GDX, while 600,000 own the dope or the marijuana stock ACB, Aurora Cannabis. So that's, I get questions, why aren't the small cap mining stocks moving? That's the reason why, is all these American people, and I think it's reflective, I'm sure it's similar everywhere, they're just in these other stocks and they need to get, once they give up on them and realize the mining stocks are going up better, then that's what's going to cause them to come alive as people are expecting.
Mike, thank you so much for chatting with us.
Great to talk with you.
My guest has been Mike Swanson, editor of wallstreetwindow.com. If you have any questions for Mike or any of our other guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.